Welcome, I'm Catherine Magana here with Rachel Ivanovich, Vince Stefano, and Steve Wolf, where we're here to share some insights about the markets, investing, and planning. So let's dig in. Today we heard some news about the economy slowing in the first quarter. It looks like the GDP came in at 1.3, whereas estimated to come in at 1.4, so it's a little lower than expected. And it's interesting, the markets have been a little choppy this week. There's been a lot of movement, so we're still up for the year on some of the indexes, but definitely we've seen a little bit of a pullback.
You know, I think we've gotten back to the inflation and whether the Fed is going to lower, raise, keep the same as far as interest rates are concerned. So I thought, I got a book here recently called Warren Buffett Speaks, The Wit and Wisdom from the World's Greatest Investor by Janet Lowe. Now, this was written probably about 10 years ago or so, but I thought it was interesting what he said about inflation. And he said, the arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislature. The inflation tax has a fantastic ability to simply consume capital. It makes no difference to a widow with her savings in a 5% passbook account whether she pays 100% income tax on her interest income during a period of zero inflation or pays no income taxes during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Any money she spends comes right out of capital. She would find outrageous a 120% income tax, but doesn't seem to notice that 5% inflation is the economic equivalent. And we've always said that inflation is devastating to portfolios. So when you are constructing a portfolio and you only have fixed income in the account, you're not going to beat inflation because it just doesn't over time, which is why we always suggest things that do beat inflation, whether it's stocks, maybe some alternative investments or some other things, real estate can, et cetera. So just be careful, and that's what the Fed is looking at right now, which is why they're so insistent on getting that inflation rate back to about 2%.
So it's interesting on inflation, when we do financial plans, we do factor in inflation because obviously the cost of living goes up. We also do the cost of living adjustment on Social Security. And to Steve's point, when we're looking at investments, that's part of that is we factored in the inflation. So when we look at the returns on kind of the overall plan. So definitely something that's real. And we've seen a lot of movement in inflation over the last few years. And obviously that's been a big topic with the Fed and with the interest rates too.
One of the things you do when you're doing your financial plan is you show what people are going to need. Mm-hmm. And if you do it in inflated dollars, they would say, no, that's impossible, right? I mean, if you look at what you'll need with inflated dollars in 15 or 20 years, it's far more than the dollar amount that you pay today with just a small amount of inflation.
Yeah. And, staying on this tangent, right now, as you said earlier, the markets were a little volatile this week. A lot of it is earnings driven. But, right now, there's a really big dichotomy between the markets, both equity and bond markets. Mm-hmm. And the bond market right now is signaling a recession is on the horizon. The stock market.
Where have we heard that before?
Right?
We've heard that a lot. But interesting enough, it continues signaling that. But since mid-March or mid-April, the stock market has gone up in anticipation of lower interest rates. But what's really concerning, and I think it's concerning the market and the bond market, is that interest on the total federal debt now is 24% of Fed spending, which is absolutely huge. Mm-hmm. It's putting a huge sway on equities. But what's interesting, even though there's this huge amount of federal debt, consumer confidence and inflation has continued to tick up. So we're seeing consumers more confident, maybe because they're just spending on their credit card. But inflation, as you were mentioning about the inherent tax that inflation puts on, look at the prices that have happened over the past 3 years. They have not come down. They've stayed high. So the big question becomes, what do you do with your portfolios? And I was talking to a client earlier this week. We were actually on the driving range, and he was asking me what my thoughts were.
The golf driving
The
range.
golf driving range, not the
Just to clarify.
not the BMW driving range. But we were talking about, it's staying with very high quality, dominant, rapidly growing companies. And the reason is because when you look at where the bond market is moving and you're seeing 2-year rates at about 5% and you're seeing 10-year rates a little over 4.6%, the big question becomes, how difficult is it for a lot of smaller stocks to go to the capital markets, raise capital to continue their revenue growth and their market expansion. So during these periods, smaller stocks tend to underperform dramatically because they don't have the capital. They can't get the capital infusion. And you're seeing that in the indices. You had mentioned the indices. Well, the Russell 2000, I think, is relatively flat for the year, where the S&P is up about 10, 11%. So again, I told them I wanted to look at the portfolios, and this is not a recommendation to anybody out there. Talk to your own financial advisor, but look at your portfolio. You've probably made a bunch of money in certain stocks over the last 18 months to 2 years. Look at the ones that are underperforming dramatically, say maybe down 25% or more. I told him I was going to look at our portfolios, sell those, and reallocate the assets into higher quality, dominant companies. Even companies that have missed earnings recently, if they're bigger cap, more seasoned companies, I want to stay with those for the next 12 to 18 months because that will help fight some of the volatility in the marketplace.
Well, the smaller companies are way more affected by where interest rates go because they can't borrow money, or if they do borrow money, it's at much higher rates right now. So it makes sense that you want to stay with, for the most part, larger companies. Especially high quality. Look, high quality never goes out of favor.
Never goes out of favor.
Right.
And right now, because of what's happening with a lot of earnings reports, people want to stay with the higher quality companies.
Yeah. Well, when you look at past history, if you look at long term, small stocks will outperform large, but that usually happens in a very, very short period of time. So sticking with the medium-sized to larger-sized companies that are high quality, I think is a roadmap to success over the long haul.
Especially when it comes to behavioral investing, and because some of those smaller stocks do have a little bit more volatility potentially.
Right. It's funny too. Again, I was, reading a lot about Warren Buffett this weekend. I was actually in Omaha. And what else can you do but either see Warren Buffett or hear or read about him? And he's basically saying that he pays no attention to the macro world. He doesn't care necessarily where interest rates are. The only thing he really cares about is the value of the company when you are buying it versus its intrinsic. So it's price versus its intrinsic value. Are you getting a bargain is really what he's doing. And he always stresses high quality, good management. All the things you think of.
And stay the course. I've read some.
And stay the course. He says his favorite holding period is forever. And he doesn't mean he's going to hold it forever. What it means is that he wants to hold it for as long as he can until things start changing. Okay? But changing as far as their earnings power is concerned. And don't look at just the stock price. And for heaven's sake, don't buy a stock because you say, I want it because I think it's going to go up. Okay, that any orangutan could do that. Okay, so you don't want to do that. You want to do some research, talk to your financial advisor, talk to whoever, but do the research on what it is you're buying. Know what you're buying.
So it was interesting. I came across a Wall Street Journal article. It was talking about big ticket items that people regret. And a few of those that I wanted to share was one was the wristwatch, which I was kind of it's interesting that that's still out there. Cabin fever and the RV to nowhere. And so I was kind of thinking about some of the clients we talk to and work with. And there are times that come up like, I want to buy an RV, I want to buy a second house, I want to, these big purchases. And once again, it doesn't mean you can't do it. It's just what's the financial impact, and also, is this something you really want to do? Maybe go rent the RV and make sure you want to travel with that, or maybe go visit the second area that you want to live in. And do you really want to be there for 6 months out of the year, or is it just a month that you want to go visit? And so I think that there's some big decisions in retirement and making sure that, what's the financial impact, and is this something you really want to do? So I thought it was kind of interesting because we do come across these types of things when we're working with our clients.
These people who buy the RVs always tells me that it's cheaper than staying at the hotels. But let's see, at about 2 miles to the gallon.
I'll say the gas prices are outrageous.
At $5 a gallon, I don't see that.
Yeah.
I've never rented an RV, nor have I ever. I don't think I've ever been in an RV for longer than about 10 seconds.
We were on an RV one time on a trip from Chicago to Detroit. When I lived in Chicago, we went to see the Bears play the Lions. And of course, it was the winter time. And on the way back, the weather couldn't have been worse. It was about 32 degrees, and it was somewhere between rain and ice. And all I can tell you is that I was, keeping my fingers clutched against whatever I could hold on to. It was scary.
So I thought we'd talk a little bit about RMDs and kind of some things that we kind of see as we're doing plans.
Let's talk about required minimum distributions,
Yes.
because why not? Because if you're over a certain age, and it depends because they keep changing the tax law. One of the things that I see with clients do incorrectly with required minimum distributions is they take the money and then they think they can just put it into their IRA, their Roth IRA. And that there are certain things that you cannot do after you take that RMD out. And one of those is put it in a Roth. There are certain rules with Roths. There are 2 tests in particular that you need to meet in order to actually make a contribution to a Roth IRA. And one of them is that you have to have earned income. So if you're retired and you don't have wages, or you don't have self-employment income, you cannot, even though there's no age limit to making a contribution to a Roth IRA, you still have to be earning income. You can't just say, well, I have my investment income or I have rental income. So one of the tests for actually putting money into that Roth IRA is making sure that you still have wages or self-employment income. The other test with it is making sure that your income's not too high, because if you are over the limit and you make contribution to a Roth IRA, you will end up paying a penalty on whatever the excess contribution is, and it's 6% on that excess every year that you keep the money in the account, and that can really add up and be a stinger. But coming back to what you were saying, Catherine, about required minimum distributions and RMDs, and tying in the Roth piece is, oftentimes people will think, okay, well, I'm going to take my money out of my traditional IRA, the required amount, I'm just going to dump it into my Roth. And you can't actually do that. You have to actually fulfill the required minimum that you take out of your traditional first, because every dollar that comes out of there up until you hit that required minimum is considered taxable income. And then you still can make that conversion later on, but you want to make sure that you meet the other 2 tests that I mentioned previously.
Yeah, so a little bit of planning. I mean, and then
planning.
Obviously, if you look at some of this before you reach required minimum distribution age, that's probably even better.
Typically, what I see is clients will come to me to do their taxes for their year, and they'll be so excited and they'll boast, I funded my Roth.
Yeah.
Okay, well,
Did
maybe
you qualify?
Yeah, exactly. So let's go through all the tests to make sure. Or they come and say, I did a Roth conversion. Are you sure? So you definitely need some planning there.
Yeah. And then if you're, I actually was working with a client, and one of the things that her husband did separately was he did a Roth conversion, and she had given him some estimates of what her income was. Well, they ended up taking out more on his end than they should have. And so there's tax consequences for that.
Absolutely.
And so I told her, okay, now make sure you're factoring in when you give them those numbers that if you're gonna be taking Social Security this year, make sure you give them that information too. So it's hard when you have 2 different advisors advising the clients have their assets separate.
It's important to look at the tax piece as well as the financial planning piece, and look at where you are, what your marginal rate is, and what your effective rate is, and kind of where the end of the next tax bracket is before you start making decisions to convert money from a traditional to a Roth.
I'm thinking about all these taxes, and I'm thinking, wouldn't it be just better just to have a flat tax period?
No.
So simple.
Yes, absolutely.
They'll find a way to complicate
absolutely.
it.
We all pay 15% of what we make and go
the
on.
story.
Call it a day.
Of course, you know what that would do for an entire accounting industry. I think it
We would
put
still
it
have
out
to
of
do it.
business.
We would still have to do accounting for businesses because you need to know what your numbers are.
All right.
Well, there you go. But
There's always someone who wants the accountants to stay in business. But
Yes.
anyway, anything else going on for this week?
Oh, estimated. Oh, that's next week. Never mind.
you already talked about it.
little
Estimated
early.
payments are coming.
Oh, right around the corner.
All right, we'll talk about that next week. In the meantime, that's it for now. We'll see you again next week. Thanks a lot.
Great.
Bye-bye.
Bye.
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 Thanks.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Weezy Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners, and Savvy Woman Wealth Management, is a registered investment advisor with the SEC.